This is The Gist, the essential podcast for the discerning listener.
Welcome to The Gist. It is Tuesday, July 14th, 2026. I'm John.
And I'm Mary. We are your smart friends on the go. Let's get right to the news that matters today.
We start with the Gist view. Today we are looking at power, specifically who holds it in the new age of artificial intelligence.
A Chinese artificial intelligence startup called DeepSeek just closed a massive funding round, $7.4 billion. That pushes their total valuation past $50 billion.
But the money is not the real story. The control is. External investors get exactly zero voting rights.
Zero. DeepSeek's founder, Liang Wenfeng, personally put in $3 billion. He took that cash from his own hedge fund.
By funding 40% of the round himself, Liang buys total freedom. He locked the outside investors in for 5 years. They have absolutely no say in corporate governance.
This is a massive shift in how tech is built. Traditional venture capitalists usually demand a seat at the table. They want a say in how a company is run.
Not anymore. Investors are terrified of missing out on the artificial intelligence boom. They are willing to hand over absolute power just to get a piece of the pie.
So who benefits here? The founder. Liang avoids the pressure to make a quick buck. He does not have to rush a product to market to please a board of directors. He can focus entirely on long-term science.
But this also means global capital markets are crowning a new class of unchecked tech kings. Power is flowing away from investor oversight, straight to the founders. And Liang, his personal net worth just doubled to $16.7 billion.
Let's pan out to the global overview. Artificial intelligence is not just making founders rich, it is reshaping national economies. Take a look at South Korea.
South Korea just bumped its 2026 economic growth forecast up to 3%. The goal? To fund massive artificial intelligence projects.
To pay for these tech mega projects, the government is relaxing its foreign exchange rules. They want to make it easier to trade their currency, the won, internationally.
Think of it like widening a highway. South Korea is removing institutional toll booths. They want foreign investment to flow freely into their tech sector.
Speaking of flowing goods, China's exports skyrocketed in June, up 27%. This created a massive $125 billion trade surplus.
Two things are driving this. First, the world is starving for artificial intelligence semiconductors. Second, United States retailers are panic buying inventory.
Exactly. The standoff in the Strait of Hormuz is escalating. This is a critical shipping route in the Middle East. The United States just imposed a 20% cargo toll there and hit Iranian military sites for a third night.
Retailers are reading the writing on the wall. They are front-loading their shipments. They do not care about cheap shipping costs right now. They just want their goods safely in warehouses before supply chains freeze.
Moving to the European perspective, let's look at the Recovery and Resilience Facility, or RRF. That is the European Union's giant post-pandemic investment fund.
A network of top European economists, the CEPR, just analysed this fund. They found it gave a quick boost to the gross domestic product in Italy, Spain and Greece. Gross domestic product, or GDP, is just the total value of goods and services a country produces.
But there is a catch. This centralised European Union debt acts like a painkiller. It masks the need for surgery.
Right. Free money from Brussels takes the pressure off southern European capitals. They do not have to make tough, unpopular choices like reforming and deregulating their labour markets.
Still, there is an upside. The funds are boosting something economists call gross fixed capital formation. That is just a fancy term for building real, lasting infrastructure. So the money is actually upgrading Europe's long-term potential.
Meanwhile, here in Germany, the spending cuts continue. The centre-right CDU party is targeting a specific welfare programme.
It is called the Unterhaltsvorschuss. It is a state advance paid to single parents when their ex-partner fails to pay children's support.
The government plans to stop these payments when the child hits 16 instead of 18.
Who benefits? The state budget. The Merz government is aggressively slashing social spending. The resource flow is shifting away from the social safety net in order to balance the books.
Over in the United Kingdom, retail looks good on paper, but bad in reality. June consumer spending rose 1.9% compared to last year.
People bought a lot of beer during the World Cup, and they shopped online.
But United Kingdom inflation is at 3%. That means prices are rising faster than spending. So people are actually buying fewer things. It looks like a retail recovery, but it is really just economic pessimism covered up by pub receipts.
Finally, Italy is looking to the atom. The Italian government is pushing Parliament to advance a new nuclear energy bill. Rome wants to secure its own power supply as European energy pressures mount.
That is the daily temperature. Artificial intelligence founders are rewriting the rules of global finance and hoarding the power to match. Meanwhile, nations from South Korea to Italy are tearing up old playbooks to secure their own tech and energy futures. The world is locking down supply lines and bracing for impact.
Thanks for listening. If you found today's episode useful, you will love our written edition. You can get the gist delivered to your inbox for free every single day. Just tap the subscribe link in our show notes.
Stay sharp. We will see you tomorrow.
The Gist, News Digest, and podcast are entirely written and produced by artificial intelligence. The Gist is out 3 times a day, every day, providing you with a liberal perspective on what to expect next. For more information and donations, visit thegist.online. Thank you for listening.